Welcome to Understanding Real Estate Cap Rates. I'm overwhelmed by the response. This has been much more than I expected, which is awesome. I really love real estate Twitter, and I'm really glad that you all had an opportunity to join today. I will be recording this, so people who missed it, I will try to share it the easiest way possible. So a little bit about me. If you follow me on Twitter, I'm Kribdilla. I am a real estate broker and advisor based in New York City. I'm also a professor at New York University. I teach real estate economics and market analysis. I've done that for about 14 years. I've also taught the negotiation and dispute resolution classes and work with Maven to try to develop a cohort class based around the market analysis and economics class I teach at NYU. And this cap rate discussion is taken from a small part of that larger class, which I hope to share more information with you about that later on. With that in mind, here is what we're going to talk about today. So we're going to cover what is a cap rate. We're going to go through the four components of a cap rate, how cap rates ought to be a function of risk, and we'll talk about some conclusions and some questions. If we can, I'd like to hold questions off until the end. That way we can just, anything that you don't like about what I'm saying or you want to ask more about, can just cover. Everybody has that opportunity at the very end. So what is a cap rate? Moses from, now over a year ago, had this fantastic, very concise definition. And I think this really encapsulates this pretty well. Cap rate is what you buy. Unlevered yield on cost is what you create. And this is an important definition because what we want to think about when we want to think about a cap rate, it's really a snapshot in time. It's what we're buying. It's what we're looking at. It's what we're analyzing, what we hope the NOI that will be on day one for the first year of ownership, and we're determining our price based on that NOI. When we think about cap rates, it's important to note we're always talking about it in terms of an unlevered return. Unlevered, of course, means without debt. It's as if we would be buying the NOI or buying the revenue stream of the asset without any debt on the property. And the reason we do that is commercial real estate debt costs vary widely depending on the borrower, depending on the terms that people are seeking. And the only way to make an apples to apples comparison is to eliminate that variable for debt. Now, that does not mean that we don't borrow, right? Of course we do. Most investors are using leverage to buy real estate. So debt is a function of our consideration, but when we're looking at assets and we're thinking about cap rates, we're excluding debt as a consideration there so that we can make an apples to apples comparison across asset types that we might be considering. As I mentioned, a cap rate is a going in return. Going in means, again, on day one, and it's with a reasonably expected expenses cost. So when we look at a pro forma, we're not looking at what the broker says. We're not looking at what we hope may happen if everything works out perfectly. It's checking ourselves, looking at our expenses, making sure what we're projecting is reasonable. Next thing, when we define cap rates, we want to make sure we understand that cap rates are derived. What we mean by derived is we must know or project the NOI of the asset, the net operating income. Once we have done that and we know the purchase price, we know what the cap rate is. We're not thinking about real estate investments as buying a 6 cap, buying a 5 cap, buying a 7.5 cap. We're really looking at the NOI. We're looking at the purchase price that we think is the right purchase price. And when we know those two things, we'll know what the cap rate is that we're paying. So it's a derived thing. It is not an objective, it's a calculation. Now, this is not to say that markets don't have prevailing cap rate environments. Of course they do. At any given time, a multifamily in the Sun Belt is going to be trading at a market cap rate. What that means, though, is it's all of the combined transactions in that marketplace. So we have a prevailing cap rate, but we have to understand that each one of those cap rates are individual, unique parcels of real estate, and the investors who are demonstrating price discovery when they're trying to figure out what the right market price for that asset will be, each one of those transactions is happening independently of each other. And what we want to make sure we avoid here is what I call the market cap rate trap. I get this frequently from investors wanting to buy in New York City as an example, and they want to talk to me about what the right cap rate is for certain assets. And that's really not the right way to think about an acquisition. And the reason for that is every single property is unique. Its income profile is going to be different from its neighbor. In dense urban markets, it's not uncommon where you'll have whole blocks of real estate were built at one time. So you're looking at 4 or 5 or 6 buildings in a row. They're all 6-story buildings. They were built by the same developer in 1920. And presumably they all have similar layouts when you're looking at them from the street. But 1910 or 1920 is a long time ago. Over the last 100 years, each one of those properties has been owned by a different owner and multiple owners, different management, different tenancy profiles, different ways they spend money or maximize returns, different types of deferred maintenance. So each parcel has to be considered on its own for its potential as a return vehicle. Because at the end of the day, that's what real estate is. It's a return vehicle. You're investing money today, and you're going to gather that return, or you're going to obtain that return on an annual basis during your hold period. So what are the prospects for return there? Last thing here is we're going to look at the rent roll and a cap rate matrix, just so that we make sure we're talking and understanding what we're referring to here. So on the left-hand side, what we have is, this is actually a real asset in New York. It's a free market, 12-unit building, shows what the square footages and the rents are for each apartment and the annual income. We have projected and actual expenses, and we have the net operating income of $237,470. On the right-hand side of the page is a cap rate matrix. And if you notice, the NOI line, of course, is fixed. If we're looking at buying the asset represented by this rent roll on the left-hand side, we are not going to change the NOI based on what we're going to pay for it. Because again, NOI is what we think the NOI is going to be at acquisition in the first year of ownership. It's a reasonable expectation of what we think we're going to collect, less our expenses. Once we own it, we get to make decisions about how we spend money, whether we spend more, whether we spend less than the seller, whether we try to maximize returns based on some management thing that we're doing, get new tenants in place and increase the income. All of those things that we're, of course, going to do once we own the asset, but we don't own it yet. We're trying to figure out what the right price is. So on the left-hand column, NOI is all the same. The middle column is the cap rate. It's included this in here because I want to make sure we understand and visualize that cap rates severely influence value. If we're in an 8 cap environment with the same NOI, the value of that 12-unit building is just under $3 million. In a 3 cap environment, that same NOI is worth $8 million. And as you can see from the matrix, and it's pretty clearly outlined here, it's an inverse relationship to value. The higher the cap rate, the lower the value. The lower the cap rate, the higher the value. If you're buying something for a 7 cap, you're getting a 7% return on the unlevered basis for that NOI. If you're buying a 6 cap, 5 cap, etc. Okay, Cribdillo, WTF, isn't this just math? Yes, it is just math. Sort of. So far, you probably all have considered this and said, yeah, why are we here? Once we know the NOI and the purchase price, we know the cap rate, we can project that out. But how do we know what cap rate is the right one? How do we know that we're paying what we ought to be paying for the return for this individual unique asset? Well, that's where the 4 components of the cap rate come in. It's generally understood that cap rates have 4 components. You probably include most of these, even if you're doing it subconsciously. You may not have ever had it enumerated this way, but you are making a consideration because it's implicit in the real estate investment. But we need to make sure we're considering it when we're making an investment decision. So the 4 components are long-term interest rates in the economy, expectation of property level rent growth, the credit of the tenancy, and then treatment of real estate taxes in the local tax code. And we're going to talk about each one. So the first component is long-term interest rates in the economy. The chart that we're seeing here has 3 lines, right? We've got in light blue, the Fed funds rate. In red, we have the 10-year treasury, and in green, we have the 30-year fixed rate mortgage. 30-year is a single-family home. It's not commercial. The different borrowing costs that we talked about before, it's very difficult to get projection that makes sense, and everybody sort of understands this idea of fluctuation in the 30-year borrowing rate. It's pretty commonly understood there. So what are we looking at here? Well, what we see here is as the Fed funds rate rises and falls, borrowing costs rise and fall. They are doing their job. When the Fed raised interest rates 25 basis points yesterday, the objective they have is to put upward pressure on borrowing costs to make it more expensive to invest in assets and equipment and spend money, make it more painful to spend money. People will spend less of it, or the threshold to actually invest money in an asset will need to be higher. If we understand that cap rates have an inverse relationship, it means we're spending less on the investment, we're going to get a higher return. So higher interest rates, lower asset prices, higher returns, higher cap rates. Lower interest rates, lower cap rates, lower returns. This is not groundbreaking, but we do need to understand that as interest rates go up, asset prices fall. As interest rates decline, asset prices get bid up. More investors think about buying assets, those asset prices tend to go up. And the last point here, for stabilized assets, the going in return should be higher than the cost to borrow money. When we say stabilized here, what we mean by that is market rate buildings that are currently getting market rent, not market rate, but market rent buildings. You have a tenant in place. The tenant is paying prevailing market rent. There's no, management upside immediately on lease rollover, something like that. You ought to be getting, at a minimum, you should be making more than the cost it is to borrow money. That's a typical thing. It doesn't mean you have to. There are other components of the cap rate where it may make sense for it to be less than borrowing costs. But if we were only looking at interest rates, that would be one threshold that we would want to make sure that we consider. The next component of the cap rate is property level rent growth. What this means when we say property level is the property itself has an opportunity to increase rents. It can increase rents in a bunch of ways, right? It can increase rents because the market rents are growing. You're in a favorable demographic that has a lot of demand for real estate assets. Rents are going up because there's constrained supply. You have a high expectation that market rents are going to increase over time. People love to talk about Los Angeles. Not a lot of developable land. It's difficult to build there because of NIMBY and other things. If you can own an asset, you have a higher expectation of that rent increasing over time. You also can grow property level rents because you have relatively low rents. Your leases, you got long-term leases rolling over to market. Market has rapidly increased over the lease period. And now you have rents that are 10, 20, 30, 40% below market. If you know that market really well, and that's the important key, that you can actually execute on this idea of the third thing here is repositioning through either re-tenanting or upgrading. This is this idea that if you dramatically changing, right? This isn't you're keeping the same tenants in place and you have an expectation of renewing them at much higher rents. This is where you're taking an asset and changing it. Could be completely redeveloping it to luxury. It could be getting rid of a tenant or not renewing a tenant that doesn't necessarily reflect the type of asset that you want to own. And you are letting the space go vacant. You're going to hire a broker. You're going to lease it up to a brand new tenant. Understanding that all of those repositioning costs add to your acquisition cost. This is where you get this thing otherwise known as unlevered yield on cost or levered yield on cost. It's no longer cap rate. It's not a cap rate because you're managing it, you're incurring costs, you're investing in the asset through time and money. So now you're looking at something like an unlevered yield on cost, not a cap rate. And the last thing to consider here is downward pressure on rents. We all like to think that rents only go up, but the fact of the matter is, especially when rents have spiked, we see plateaus or declines in rents. We saw it in New York City in 2018 and 19. Rents had dramatically increased into that period of time, and we saw market rate rents plateauing. Right? Doesn't mean property level rents were plateauing. It means market rents were slowing dramatically. We're seeing that in Sunbelt states. We saw a high expectation of rent growth. We did see spike in rents driven by COVID demographic changes, high demand rapidly, and all of a sudden rents spiked. We're seeing that cooling off. We're seeing rents fall in those markets. So if you have a low expectation of property level rent growth, that's okay, right? It doesn't mean that you shouldn't buy. It just means you shouldn't overpay for that asset. You're going to pay a higher cap rate, a lower value to make sure you're compensated for your investment. Third thing, credit of the tenancy. Credit of the tenancy, we see in our pro forma line here, our expense line, as vacancy and credit loss. We typically say that in a multifamily asset, 3%, 4%, 5%, whatever it is. Typically in commercial real estate, when we say the credit of the tenancy, we're referring to things like retail tenants or office tenants. where you may have a mom and pop store versus a national tenant. Mom and pop doesn't have nearly the credit of a corporate-backed national tenant. Your expectation of payment for that rent is less with a mom and pop than it is with a national tenant. Therefore, with a national tenant, you can pay a higher price, therefore a lower cap rate. You're getting cap rate compression because you have a high degree of certainty that you're going to get paid at least in the near term. So that's how we typically talk about credit of the tenancy. But we also are starting to see something. It's always existed, but it's coming up more frequently now. Is this idea of legislative or legal credit? This is more like a market issue. Typically, and I shouldn't say typically. We definitely see it in New York City. New York City, if you have a problem tenant, it's difficult to evict. It has always been difficult to evict those tenants. It may take 6 months to a year. That was pre-COVID. Now we have lots of other red tape issues about trying to remove tenants and proposals for things like non-eviction. If you are investing in a market that has a high degree of difficulty of evicting non-paying tenants, you need to factor that in the cost of ownership. Your long-term prospects for collecting all of the contract rent that is owed is lower in that type of a market versus a market like Florida or Texas, where you have more favorable landlord laws where it's easier to get the marshal to come to evict tenants for non-payment. So we want to think of this as credit of the tenancy. It's either the tenants themselves or the market that you're operating in. The last one is treatment of real estate taxes in the tax code. Just so happens that our friend Baker has been talking about this quite a bit. And it is when he talks about his investments in Texas and how his real estate tax payments have come due. And it's so brutal in Texas that it marks to market every bleeping year. That's basically like paying a gross receipt tax to a franchisor. So the idea here is Texas, you're in business with Texas if you own a property in Texas. Why is that? Well, Texas, because it has low or no state taxes, relies pretty heavily on real estate taxes to support the local and state municipalities. So they look to landlords to fund their operations. It's not just Texas, though. New Jersey and New York also have very high taxes, relatively speaking. And in New York City, you have what are called protected asset classes, and you have non-protected real estate asset classes. 1 and 2 family brownstones, tax increases are capped. 6 families are going to fluctuate with the market. Your taxes can increase dramatically. So when you're thinking about your fourth component of the cap rate, you're talking about real estate taxes in the tax code. Why is this important? It's because the long-term ownership of real estate means that every year you will face the potential of having significantly higher taxes from the year before. And real estate taxes are what we consider to be an above the line expense. It means they come out of income before we calculate NOI. So with the NOI number decreasing because of higher real estate taxes next year, it means that it's going to potentially affect the future value of your assets. You have to factor that in when you are making an investment decision. So that's the 4 components of the cap rate. One more thing, though. I want to make it clear that when we're talking about cap rates, we are supposed to be talking about them as a reflection of risk. What does that mean? What it means is a high cap rate asset, meaning a high return asset, 6, 7, 8, 9, 10, right? High cap rates. It means that you are exposed to a higher level of risk by definition. It is possible that an asset is mispriced. It is possible there's an inefficiency. It's poorly marketed, it's poorly owned, it's a high cap rate, and it really should be a much lower cap rate. Ideally, that's what we are targeting as investors. Okay, we want to capitalize on something that's mispriced. It should be a 6 cap, its price is a 7 cap, perfect, boom. But in the event that it's not, and more often than not, it's not, if you're getting a high cap rate return, you are facing market risk. There is some market risk in there that you need to determine why it's priced the way it's priced. There is no free lunch. Conversely, in a low cap rate environment, your low cap rate should reflect relative security of income. If you're going to buy an asset, a real estate asset at 3.5 cap, you better be pretty sure you're going to get that 3.5% return year over year. because you're paying a lot of money for it. It should be relatively risk less. And if there's risk in there that you're not being compensated for, it means on a risk adjusted basis, it's a bad investment. So cap rates are a reflection, or should be a reflection, of risk. And historically, they have been. When you talk about multifamily in a dense urban market where there's lots of demand, those are relatively lower cap rates, because high demand means you're going to have less opportunity for high vacancy and more opportunity to lease those properties when they roll over. In a less dense market, you ought to have a higher cap rate because there's less demand, less job growth. Doesn't mean it's a bad market. It can be an awesome market. It can be a great market for, investment and long-term prospects and all those things, because it's really, really stable, and that's great. But you want to make sure that if you're investing in a tertiary market, you're being compensated for the underlying market risk that's there. And one of the things that we've seen in this last cycle is this idea of cap rate ambiguity, agnostic cap rates. The cap rates in Allentown, West Virginia, or Allentown, Pennsylvania, are the same as they are in LA, or the same as they are in New York City. And that is, historically speaking, not something that we've seen. And it doesn't mean Allentown's bad. Allentown's wonderful. Its long-term prospects are very different than LA and New York, and you need to be compensated for that additional risk. So, in conclusion, what's a cap rate? Hopefully, you have a better understanding, or can articulate more about what cap rates actually are. You probably knew a lot. Hopefully, you learned a little bit more. Know the four components: interest rates, expectation of rent growth, credit of the tenancy, and how real estate taxes ought to be priced in. Are there any questions?